Hey everyone, welcome back to Corporate Decoder. Today, PSQ Holdings Incorporated just filed its preliminary proxy statement for its upcoming annual meeting, and I am seeing one red flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is trying to avoid a delisting from the New York Stock Exchange, and a reverse stock split is on the table. Alright, let's dive into what is going on at PSQ Holdings Incorporated. This filing is for their annual meeting of stockholders, which is scheduled for July 9th, 2026. It is basically a yearly check in where the company tells its shareholders what is up, what they're voting on, and how the company has been doing. So, right off the bat, we see a few key things they want to discuss. First, they're electing new directors, which is pretty standard. Then they're ratifying their accounting firm, also pretty routine. But then things get interesting. Proposal 3 is a big one. They want approval for a reverse stock split. Remember, this is a preliminary filing, so they are laying out their intentions. They are proposing to combine shares of their Class A common stock at a ratio anywhere from 1 new share for every 5 old shares, up to 1 new share for every 15 old shares. The board of directors will get to decide the exact ratio within that range. Why would a company do this? The main reason they give is to try and get their stock price back above $1. We see here that on February 10th, 2026, they were notified by the New York Stock Exchange that they were not in compliance with the rules. Specifically, their stock price had fallen too low on average for too long. The same headline from Investopedia in 2023 talked about their shares skyrocketing on their first trading day, and now here we are. It is a common story for companies whose stock prices fall significantly. This news from May 2026 saying they have 18 months to avoid delisting makes this reverse stock split proposal even more critical. If they don't get their stock price up, they risk being kicked off the New York Stock Exchange. And that is a huge problem for shareholders because the stock becomes much harder to trade and less attractive. Let's look at what this could mean if they do a 1-for-5 split. And as of May 2026, they had almost 50 million shares outstanding. That would immediately reduce the number of outstanding shares to about 10 million. If they go with a 1-for-15 split, that number drops even further to around 3.3 million shares. For example, if they had 49.765263 shares outstanding before the split, a 1-for-10 split would leave them with just under 5 million shares. Now, what are the risks? Well, the company admits that a reverse stock split doesn't guarantee success. Investors sometimes see these splits negatively. It can sometimes signal underlying business problems. Also, the liquidity, meaning how easily you can buy or sell shares, might actually decrease if fewer shares are available, even though the goal is to make it more attractive. They also mention that the percentage of ownership by stockholders remains the same, unless they get cash for fractional shares. For most US shareholders, the good news is that this reverse stock split is expected to be treated as a recapitalization. This means you generally won't pay taxes on it unless you receive cash for a fractional share. The tax basis of your old shares will generally carry over to your new shares. This is often a sigh of relief for investors holding through this kind of corporate action. The fourth proposal is about approving an updated stock incentive plan. This plan is basically how the company gives out stock options and other stock-based compensation to employees, directors, and advisors. They are asking for approval to add an extra 1 million shares to the pool available for these awards. This is aimed at attracting and retaining talented people. The plan details how shares are counted for these awards. When a stock option is exercised or a stock appreciation right is settled, those shares can go back into the pool for future awards. They have specific rules about how many shares can be granted, especially to non-employee directors, which is capped at $750,000 in value per year, or $950,000 in their first year. Now, let's glance at the financials, specifically executive compensation for 2025. Michael Seifert, the former president and CEO, received a salary of $300,000 and stock awards valued at $197,500. Randy Carlson, the chief technology officer, got a salary of $350,000 and stock awards worth $609,119. Michael Hebert, the former senior vice president of People, also had a salary of $350,000, with stock awards valued at $592,500. Looking at outstanding equity awards as of the end of 2025, we see Mr. Seifert had 27,500 RSUs with a market value of $28,325, and another 50,000 RSUs with a market value of $51,500. Randy Carlson had a good chunk of unvested RSUs too, totaling 159,389 shares with an approximate market value of $164,800. Michael Hebert had invested RS totaling 233,334 shares valued at around $241,700. These numbers show how much equity compensation is tied up in these executives. When we look at who owns the most stock as of May 2026, it is interesting to see the breakdown. Aliska Investment Group LP is a major shareholder, owning close to 9% of the class of common stock. Among the directors and officers, Davis Pilot III owns about 4.67%, and Michael Seifert, the former CEO, owned about 4.64%. Donald J. Trump Jr. holds about 1.58%. The group of all current executive officers and directors together holds about 12.21%. It is worth noting that there were some late filings for Section 16 reports, which are supposed to report ownership changes for insiders. The filing mentions administrative errors caused the delays for several individuals, including Mr. Pilot, Mr. Masters, Mr. Ayers, and Mr. Rin. While these are usually minor hiccups, it is something to keep in mind. There is a mention of a consulting agreement with Nick Ayers, a board member, through his company C6 Creative Consulting Incorporated. He receives a monthly fee of $30,000 and was granted RSUs. There is also a consulting agreement with Donald J. Trump Jr., who also receives a monthly fee and was granted RSUs. These are important because they show how people connected to the company are compensated for services beyond their directorship. The company also issued convertible notes purchased by affiliates of board member Davis Pilot III. They raised $10 million in March 2024 and another $10 million in August 2024. These notes are convertible into shares of Class A common stock. This is a way for the company to raise capital. In October 2024, they closed a private investment in public equity, or PIPE, selling shares at $2.70 each. Descanted Capital LLC, an affiliate of former board member Kelly Loeffler, bought a significant chunk. B-Led LLC, controlled by Steve Seifert. The father of Michael Seifert also purchased shares. Even Willie Langston, who wasn't a director then, bought shares. This shows a mix of strategic investors and individuals with connections to the company. Now, looking at the overall picture, PSQ Holdings Incorporated is in a tricky situation. They are facing potential delisting from the NYSE due to their low stock price. The reverse stock split is a direct attempt to fix this. Historically, companies that undergo reverse splits often struggle to maintain compliance. For example, when Kodak did a 1-for-20 reverse split in 2021. Their stock saw about a 40% additional drawdown over the next 90 days, and they eventually faced significant challenges. About half of microcap companies that do a reverse split end up delisted eventually. The approval of the amended stock incentive plan shows they are trying to keep their talent pipeline strong, but the effectiveness of that is tied to the company's stock performance. The executive compensation figures, while substantial, are within expected ranges for companies of this nature, particularly with equity awards aiming to align interests with shareholders. The key takeaway here is the delisting threat. Will the reverse stock split be enough, or is it just a temporary fix before facing the same problems again? That is the critical question for investors. The company is betting that by increasing the share price, they can regain compliance and avoid a move to the over, the counter markets which would be detrimental for existing shareholders. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.